Well, hello everybody. My name is Sunil, and I am a Forex trader, primarily trading the currency market since the last 19 years, almost 20 years now. And I want to talk about the basics of the markets, how the Forex markets work. This is the first part of the series that we'll be doing some small videos on the basics of the market. Most traders who come into the market, and you could trade any financial instrument, but we are sticking to the currencies. The statistics is that almost 90% of the retail traders lose money in Forex trading. When I talk about retail traders, I'm talking about individuals like you and me. We are not talking about banks, institutes, professional traders. Professional traders may be individuals, yes, but we're not talking about funds or banks or institutes. Now, why is it that most traders lose money? The simple fact is that they're doing it the wrong way. As they say, the market is never wrong. If you are losing, it's you who's wrong. Let's just try and tie up some fundamental factors to the technical factors, because as traders, obviously we look at the charts. In my years of experience, in my years of trading, it's come from my experience looking at the banks, looking at how people trade, being successful over a number of years. Initially, I wasn't successful, to be very honest. Like every trader, I did lose a lot of money. But eventually, I went, stuck to it. I went after it, discovered some new things, and decided that there's something there that makes the market works. And if somebody is successful, there has to be a way. In the process of my career, obviously, since I became successful, I've also done some trainings for banks. I've sat on the trading floors of the banks, and this changed my perspective completely because now I was on the other side. Let's just talk about the banks. So these fundamental reasons, and very specifically to the Forex market. This is a huge market, trading almost $6 trillion a day as a turnover. But the simple fact is that most people do not know that almost 60 to 70% of this trading is done for speculative purposes, and most of this speculative trading is controlled by the banks. Let me show you something very interesting right over here. This is the global market share in 2019, which the BIS takes out a survey of. And as you can see, there's a group of 10 banks, starting with, I'll read it out from you, starting with JP Morgan, Deutsche Bank, Citi, XTX Markets, UBS, HSBC, Bank of America, Merrill Lynch, etc. If you total this up, it's almost 65% of the trading. They are the ones who control the currency markets. Now, obviously, the currency markets are too huge and it cannot be controlled by somebody, but they have the capacity to drive the markets. So the simple fact is, whenever you're trading, any trader who's trading, when you're buying something, somebody has to sell it to you. When you sell something, somebody has to buy it to you. In Forex trading, in the currency markets, a retail trader who is buying or selling, the opposite side of your trade, my trade, let me classify myself as a retail trader, is a bank. And obviously these people, the banks, the institutes, let's just call them the 10 percenters. These 10 percenters have got huge resources, they've got deep pockets, enough to shake you out of the market. So if you are not careful, obviously you are dealing with the best of the best, as they call. This is the first and simple factor, that you better be careful and be very clear about what you're doing over here. That's first. Second, why do really traders lose money? Well, they approach it in the wrong way. This is what I've seen. And it's honestly not really a trader's fault. If you do a Google search today on trading systems or Forex trading, you'll probably come across a million people selling their courses, lots of courses. Most of them talk about indicators. So a new trader obviously thinks that this is the way to go. All right, everybody's using indicators, so I should. But this is where the main mistake or the major error that they create is they go with indicators. Let me give you an example. I've pulled up these charts over here. Right, we are somewhere on the right, hard right edge of the chart, as we call it. I don't know what's going to happen. And price starts moving up. I've got a regular stochastic oscillator over here with the standard settings, which every chart has. The simple fact is that on a stochastic or any oscillator, If your stochastic goes above 80, as you can see, I'm just pointing it right here, price is considered to be overbought and you should be selling it. This is what traders tend to do. And going a little ahead, you have this simple crossover, that if you have a crossover of two lines in the overbought area above 80, well, price is going to go down, and you sell. And you sell, and what happens? It just keeps going up. And then it's still overbought. Now this trader looks at it, oh, now the stochastic is going down. Yes, it's going to go down. And he or she would probably just, let's say, plot a trend line and say, okay, a trend line break will also be fine. And I'm going to look at this. And you have a wick coming out, but price still keeps going up. And it just keeps going up and up and up. In a trend, the simple fact is, when you're using an oscillator, if it is overbought, it actually means that your overall trend is very strong. And you should not be fighting the trend. You should be going along with it, which is one of the main things that the trader gets trapped out on. The second indicator, which is something which I don't like personally, is moving averages. I mean, let me just move this. Moving averages is they are one of the most lagging indicators. But even today, I see a lot of traders who tend to use moving averages in an incorrect way. Yes, they are effective if used properly to look at a trend, but they use simple things like moving average crossover. I've just plotted two basic moving averages over here, a standard 50 and a 13, which I've seen a lot of traders use. So what they tend to do is, when this red, the 13, crosses the 50 towards the upside, this is a place where you're supposed to buy. Let me plot a line over here, right? There you go. And let me zoom it a little inside. When did you buy? You bought when this crossover took place over here, which means this is the place when you buy. And what's happened over here? Prices started going down. Now look at two very important things. Where did this move start from? The trend, where did it start from? It started from here. As a retail trader, if you're following an indicator, you have missed out on the meat of the move, as they call it, which is where the professionals are, because they start the move, right? They have the capacity to do so. And we'll cover it later as to what could be the reason why they could start a move from here. But here they start the move, and a retail trader comes in on a crossover somewhere over here. Now, logically, if price is going up and me as a retail trader want to enter over here, I have to buy it. If I have to buy it, someone has to sell it to me. Why would someone want to sell it when price is going up? Well, it's the 10%ers who are selling it. They have taken so much of profit, time to offload their profits. And when a retail trader comes in at this stage, and they know exactly when a retail trader is coming in, believe me, they do. They are the ones who are selling it. Obviously, a retail trader is trading with $5,000, $10,000, $20,000. The 10%ers will place a sell order for, let's say, $500,000. And what happens? More sellers than buyers, price goes down, and the retail traders get stopped out. The basic principle. So there are 2 points. One, knowing that who's against you. Second, using the wrong principles. The third and the most important point was, most traders do not consider. Everybody wants a holy grail in the market. But what they don't understand is, unless you do not implement the concepts of what I call as the 3 M's, money, mind, and method, in that order. I could give you the best trading system in the world, but if your risk management is not correct, you're not going to make money, period. And if your mind factor is not put into your trading, you're not going to make money. And this is something which we'll cover on the next part of the video. But most traders come in with the wrong information, with the wrong approach, and it's not surprising they lose. What we tend to do, and again, it's based on my experience, on the experience of the traders that we have. We trade along with the banks. We have systems which keep us aligned to the professionals, to the 10%ers, which, if I may say so, are effective. Effective? How effective are they? Well, do we have losing trades? Of course we have losing trades. Losing trades are a part and parcel of trading. But it's all your factors put together with your money management, your mind factor, with the correct method. A amalgamating everything together to make a proper plan. That is what makes a successful trader. We'll talk about it more next time. Good talking to you, folks, and I will see you soon again.